So if you've decided that index funds have a part to play in your investing portfolio, great. So that's exactly what I'll be talking about today. I'll be covering what are the popular index fund ETFs that are listed in the US, and then what are some of the other alternatives that we could probably save a little bit more year on year. So if that's what you're interested in, stay tuned for the rest of the video. Hey guys, it's Sunmin and welcome back to Your Money Game, the show where we get better with saving, spending and investing. Articles and videos from Americans that tend to talk about index funds usually refer to their mutual fund structures. Investors like us who happen to be from Asia actually need to consider the ETF versions of them. And personally, I don't see it as a problem because it actually is an easier structure for us as investors as well. So, for the sake of clarity, everything that I mentioned here are specifically US listed ETFs, but there will be instances where I talk about alternatives that are non-US listed, and I'll call them out specifically so you'll know which ones I'm referring to. So let's start with the ETFs that cover the US markets because they're the biggest, they're the best, and that's exactly what most investors are looking for. The elephant in the room is the S&P 500 index, which basically tracks the 500 largest companies in the US. And you can own this by buying the ETF SPY, which, fun fact, happens to be the most popular ETF in the world. The current price is about 330 plus per share and its annual expense ratio is about 0.09%. But for non-US based investors, the thing that you need to understand is the additional costs which you have to pay in this thing called the withholding tax. So the withholding tax is simply a tax that's charged to you on any US listed ETFs on the dividends that you receive. And for us who happen to be investing from Singapore or Malaysia, you'll be paying a 30% rate. For example, if you happen to own a US stock or ETF, which pay you a dividend of say $100, you would have to be paying them $30 of that as a tax. You don't need to kind of make a new transaction, it is actually automatically deducted before it even hits your account. So let's get back to the example of SPY. It roughly pays you out at 1.7% dividend rate on an annual basis. So if you do the math, paying 30% of that roughly equates to 0.51% in terms of additional fees. So if you add that to the 0.09, your effective fee for an annual basis is roughly 0.6%. Now, of course, dividends tend to fluctuate, but by and large, when it comes to index funds, they tend to be fairly stable. So there is a way for us to reduce the annual cost of ownership of a fund like this, and that is to look for ETFs that are called UCITS, UCITS. And these are ETFs that happen to be domiciled in Ireland, meaning they were registered there. Now, while the ETFs are registered in Ireland for tax purposes, they are actually listed in other stock exchanges in Europe. They are still charged the withholding tax, but it's only at 15%. So what is the alternative to SPY if I wanted to save a little bit more on those taxes? A really good option is to have access to the London Stock Exchange and to look for an ETF there called VUSA, which is basically tracking the same thing, the S&P 500 index. So you'll be paying roughly 0.07% on the base expense ratio, which is already cheaper than the SPY. And on top of that, what you'll be paying in terms of withholding tax is roughly 0.25%. So the cost of your total ownership is roughly 0.32%. So you might be thinking to yourself like, hey, that's a really small amount. Why should I even need to care about all of this? And you're absolutely right, because if you are starting out or your account size is fairly small, you really don't need to care about all that. Access to the US markets is obviously the more popular choice. In my humble opinion, I don't really think people should care about it until they hit a six-figure portfolio size. But knowledge is important, so at least you know what are the options available to you. So if you're sticking around in the US markets and you're still interested in the SPY, but you want a cheaper alternative, there actually is one, and it's called SPLG. It's actually issued by the same guys, and on top of that, it's actually even cheaper to own because the cost of it when you buy, it's roughly $38. And it has an even lower expense ratio at 0.03%. Moving on to the next most popular index at this time is probably the Nasdaq Composite Index. And that's basically the tech index of the US. Through the ETF QQQ, you'll be able to own 100 of these top tech companies for a small fee of 0.2% annually. And when it comes to tech stocks, they tend to pay out lower dividends. So the annual dividend rate roughly is about 0.59%. After doing the math, you'll be roughly paying an additional 0.17% on top of the 0.2% of annual fees. So that works up to be a total of 0.37% of cost of ownership in a year. An interesting alternative here is for you to consider VGT, and that's another tech index ETF, which is a little bit more diversified at roughly 332 stocks as opposed to the Nasdaq QQQ, which owns roughly 104. The best part is that the annual expense ratio is a little bit lower at a 0.1%, and the annual dividend yield is a bit higher at roughly 0.92%. You'll have a total cost of ownership of roughly 0.4%. It's not that far from QQQ, but you have higher diversity and on top of that, roughly similar performance. So you might be asking, are there any UCITS options that I should be considering? And honestly, I found a couple, but they're not really that good once you factor in the additional costs. The next really popular option is to broaden your horizon even more by trying to own the total US stock market. And you can own it all with an ETF called VTI. Its annual expense ratio is super low at 0.03%, and once you factor in the withholding tax, you'll be roughly paying a total cost of ownership of about 0.54%. So I've tried hunting for UCITS alternatives for you, and frankly speaking, I couldn't find anything that could match that. So I think the best bet for you here is really just going with VTI. So now that you've gotten the whole USA kind of figured out, let's broaden it even more. Let's own the entire world. And that's the next most popular ETF, which is owning VT. This total world ETF covers 8,700 plus stocks, and all done at a super low fee of 0.08%. Once you add in withholding tax, you'll be looking at a total ownership fee of roughly 0.68%. Here, there is an interesting UCITS alternative, which is listed in London, and it's called VWRP. So your rough total cost of ownership is about 0.55%. It's not that much cheaper, and you own significantly less stocks at about roughly 3,400 in this ETF, but it's an interesting alternative that you might want to consider nevertheless. So the popular options that I just talked about usually help form the core of most portfolios, but then the next few that I want to talk about are for diversification purposes. And again, these are my personal opinions, so please take them with a pinch of salt. Starting with regional diversification, a lot of people tend to look towards this class called emerging markets, which pretty much covers a large swath of Asia, and on top of that, countries such as Russia and even Brazil. You could look at an ETF called IEMG, which has an expense ratio of roughly 0.13%. The UCITS ETF here is really worth considering, and it's called EIMI. Its annual costs are 0.18% and its dividend rate is roughly 2%. One other really popular diversification tool is to use gold. And a great option here is to look for OUNZ, which has an annual expense ratio of 0.25%. And because it's gold, they do not pay out any dividends. So that's pretty much the only expense ratio you need to think about. So those are the options which I've researched, which I think are really good alternatives to become the core of any portfolio. And of course, after that, anything you want to do is additional research on your own, which I fully encourage. And the resources that I tend to use for US listed ETFs are ETF.com. And for any UCITS based ETF or those that are listed in London or maybe Germany, use a site called justetf.com. So hey, I hope you guys found this useful, and if you did, I really would appreciate your support in hitting that like, subscribe, as well as that bell button, because I'll be back again next Sunday with a brand new video. So till then, you take care and keep playing your own game.